Good morning. It is 10 o'clock on the 6th of August. It's a very cold day here in Cheddar, relatively speaking to some of the weather we've been getting. But this is episode 5 of Southbank Live, our live show. It's something of a prototype so far. We're just seeing how it works and whether or not we can make something of a success of it. There's a live show where we discuss market events that you may have missed or which may be sort of lurking under the surface, which the mainstream press has not been covering, and discuss it in as much detail as we can. I'm joined today, as ever, by John Butler. John, how are you getting on this week?
Yes, very well, Boaz. How about you?
Very well indeed. It has been a very busy week, and it's been pretty crazy when it comes to some of the stories we've been seeing coming out. But yeah, I think it's one of the things I'd like to start off with is our main sort of theme for this episode is the very curious case of the Chinese tech wreck that has been going on, which actually I don't see nearly as much coverage of it as I think it should, simply based on its entire size. So just to give an idea of how grand the sell-off in Chinese tech has been over the past few weeks, I've seen estimates of $1.2 trillion worth of market cap, of course, adjusting for the renminbi, has been lost, and that's an awful lot of money. I would think. I mean, we are in 2021, and trillions are getting pushed around and talked about in a very blasé fashion. However, I do think that what's going on here must have some kind of effect when it comes to Western capital markets, and I was hoping that you may be able to shed some insight on that.
Well, you can take a look at history to some extent here, right? Now, the Chinese tech sector, of course, is no longer small, as you point out. In a few weeks' time, you've taken off roughly $1 trillion of US of market cap. And yeah, that's a big number. Adjusting that number for history and inflation and the growth of markets and whatnot, I mean, it's not exactly comparable to the Nasdaq in 99 2000, but it's not as if it's irrelevant either. So I think it's difficult to draw any definitive conclusion, but I think it is significant in terms of size. What I think is more significant, though, is the qualitative nature of what's going on, because there's a lot of divergence now, okay, between what's happening in China and what's happening elsewhere. Now, we've pointed this out before, and I think it's important to note China was always ahead in this cycle. They were ahead in this cycle because they went into lockdown first. They came out of lockdown first. They stimulated a lot. Then they started tightening credit. And they started tightening credit conditions already last year. And in fact, more recently, they've begun to ease them again. But as we know, the links between economic and monetary conditions on the one hand and the behavior of financial markets, including equities on the other, the lags and leads are long, they're unstable and unpredictable, but they're there. They're there. And any meaningful tightening of credit, if left in place for a sustained period of time, will eventually have some effect. It's going to show up somewhere. And sure enough, it tends to show up in the most highly leveraged and most highly speculative areas. And so sure enough, it has showed up in Chinese tech. I couldn't have timed this precisely, but I'm not at all surprised that it's been happening. So then the next big question is, okay, China's been ahead in the cycle here, but how far behind is everybody else? At what point are the developed economies perhaps going to start to exhibit a similar result here? And that's where it gets really interesting, because notwithstanding previous rhetoric coming from all central banks, including the Federal Reserve, only now, and I stress now, literally this week, only this week, have we started to hear the first hawkish indications coming from a couple of Fed officials and a smattering of other central bankers around the world that, whoa, this inflation rise, while not entirely unanticipated, is probably at some point going to require a policy response. That's a significant shift. And so I think now, with China setting an example, being ahead in the cycle, and central bankers in developed economies starting to change a rhetoric a bit, we could be now in a major correction, a general correction in stock markets and risky assets could be right around the corner.
Yeah, just to give some context for those watching, and if you're watching live or if you're watching a recording of this, just to be clear, I did save this chart a couple of days ago, so it's not the most up-to-date version of it. But if we just take a look, if I speak to the man behind the curtain, if we just get the chart of the QEB, which is the Chinese tech ETF on the screen. It'll just show you just how extreme the sell-off has been. So this Chinese tech ETF that you can access here in Western capital markets, and it just takes a couple of indices. Well, it takes one index, it follows it, and tries to invest as evenly across it as it can. And effectively, we've seen a 50% wipeout over a relatively short space of time. So, which is one of the reasons why I find it so interesting that we're not seeing quite as much coverage of this, because you could actually be exposed to this move if you have been indulging in some of these more exotic ETFs. So that one's the Queb. There are other ones out there, but I'm just using this as a proxy for the sector because, of course, not all Chinese stocks are actually available for people in the West to access. John, the saying has always been, the American economy catches a cold. The American economy sneezes and the world economy catches a cold. I guess the question I'm asking is, what this has been the Chinese tech sector sneezing. Are there going to be any, who's going to be catching a cold from that, I guess is the question.
Well, again, I think it's difficult to draw a direct causation here between the Chinese tech sector, which is highly speculative and highly leveraged, and the global economy and global financial markets more generally. I think it's more, again, it's a qualitative signpost that the tightening of Chinese credit conditions we saw previously, and the fact that China has been leading the cycle all the way, that it's kind of playing out now there, and a similar pattern may well begin to play out elsewhere, especially if central bankers continue to get a bit hawkish as a result of this rise in inflation that we've now clearly seen in the US, in the UK, and to some extent now even in the euro area. So it's a warning sign, right? It's a warning sign that what we've kind of already been hinting at, that is that stock market valuations look pretty elevated, given the bigger picture, that maybe indeed a correction is now imminent. And one other thing I would point out in that regard is that the divergence itself is a concern. Again, the NASDAQ bubble popping in 99, 2000 was of much, much greater magnitude in terms of its overall contribution to market cap at the time. And yet you had a lot of divergence there also, right? The NASDAQ had fallen by, I forget what it was, but on the order of magnitude of 40 to 50% before the S&P rolled over, right? I mean, it was a big, big drop over a multi-month period before the broader stock market noticed what was happening in tech. So the divergence itself is also a warning sign.
Yeah, it. They say obviously no one ever rings a bell at the top, and one of the things that I find so interesting about the story is that there isn't that much coverage of it, which kind of makes me think that, well, maybe people have been so used to, they're so addicted to more positive news that maybe this is a symbol of something greater. But of course, with China, there is always a much more political level to some of these financial market movements. They've got they call it civil military fusion, but in a way it's sort of market political fusion going on there as well when it comes to why certain assets are going up and why some are going down. Xi Jinping has done a pretty he's cracked down very hard on a lot of the tech guys, Jack Ma being probably the most obvious example. And then earlier this week, we have the spiritual opium comment coming from Xi Jinping, where gaming is being cracked down on pretty hard. What do you make of all that, John? Do you think there's, it seems to me that China is definitely going moving away from a market-based economy for as much as it went towards one. It feels to me that we're going in reverse now. But what do you
look? I mean, ever since Deng Xiaoping said, decades ago that to grow wealthy is beautiful, or I forget exactly how it translates best into English, but something along those lines, or glorious, right? To grow wealthy is glorious, or something. China's had this love-hate relationship with anything resembling a free market ever since they began to move in that direction. And so, there's constant back and forth. As you say, it's very, very political. When it's politically convenient to let it ride, they let it ride. When it appears perhaps to be causing some trouble for the party, then of course they're going to tighten it up. Look, I don't want to belittle what China has achieved. Okay, I mean, look, I'm not a fan of socialism. I'm not a fan of heavy-handed, arbitrary, politically driven regulation. I'm a free markets guy. Okay, however,
you're in good company, John. Don't worry.
But you've got to give China some credit. Okay, they clearly, on balance, overall, have allowed enough free market competition to achieve some astonishing things. But the idea that they have fundamentally recanted, the idea that they're now fundamentally free market capitalists, is I think just so culturally off the mark. And it's not, and I say culturally for a reason. It's not, this is not strictly ideological. I mean, there are deep cultural reasons why the Chinese economy and political system functions the way it does. I mean, look at how, look at how the Forbidden City, ruled China for, dynasty after dynasty after dynasty. China's always been centralized. It's always tried to control what it can reasonably control from the center. It's always been skeptical of decentralization and entrepreneurialism. So to the fact that they've tolerated it to the extent they have in recent decades, I guess in a way is quite an achievement. But if they suddenly start going back the other way, I'm not going to be surprised. And we are seeing a lot of it now, right? They were intervening in coal and iron ore because they were concerned about those markets. Obviously, the way they manage credit is much more fine-tuned than in the West. You usually just turn on the spigot or turn off the spigot, whereas in China, they try to direct credit to, okay, we're going to focus on housing now. Now we're going to focus on infrastructure. Now we're going to focus on exports, whatever it is. And that's never really gone away. And I'm not surprised to see them getting a little bit more active now that we've gone through this most recent, very artificial cycle driven by coming into and coming out of lockdown.
Yes, the subject of Evergrande is becoming once again a very big topic in the financial market commentary, as it were. This incredibly large Chinese debtor, whether or not the Chinese state will allow it to go will allow it to default, because if it did, it would be an utterly enormous bankruptcy, which no doubt would have a lot of ripple effects going through the global economy. We have to remember China as such a large commodity consumer it's a country which so many people are relying on to pull global growth forward to some degree. So if things go wrong in China, the world will feel some kind of effect from that. Sure, just from the commodity consumption and its exported products. Do you have any thoughts on the Evergrande? Could you give some context for us, John, for what is Evergrande? I believe as you're saying, how China is very good in some ways with fine-tuning credit, with really sort of getting into the bushes rather than just raising interest rates. They do a lot more when it comes to debt and how debt is accrued. I believe the term, and I believe it did come out, it was raised first in China. Instead of having a black swan event, they came up with the definition of a gray rhino, where instead of something that you cannot consider ahead of time, a gray rhino is absolutely obvious. It's enormous, and when it charges around, it's really quite it's very, very noticeable. And they use this term, the gray rhino, to describe really bad credit risks. So banks which may go bust, or very, very large debtors which may default. And I think Evergrande would probably be the largest gray rhino of the gray rhinos. Yeah, could you give us a bit of background to that and what your thoughts are on it?
Well, as just discussed, right, if you do have a potentially systemically large bankruptcy looming, it's almost inconceivable that there are not going to be very high-level discussions within the CCP regarding what to do about it, because they will do something, right? They're not just going to step back. First of all, it's simply embarrassing, right? It's one thing for a firm to go bankrupt, but for that bankruptcy then to result in a cascade of disruptions, it just makes the people in charge look bad.
Yes.
So they may well step in, but they won't necessarily prevent the bankruptcy. But what they'll do is they'll find ways to contain it, right? They'll find ways to contain it and find ways to make sure that it doesn't cascade the way Lehman Brothers did. They don't want to be embarrassed. That was embarrassing for the United States, and to a lesser extent for the entire Western financial system. And I'm sure there were lots of chuckles in Beijing and Shanghai and whatnot as that was playing out. And they don't want that this Evergrande or any other potentially systemic bankruptcy within China to result in a loss of face. They want to appear strong not only internally, but vis-a-vis the rest of the world. And so they will indeed step in and contain it. Now, of course, there's no free lunch. To the extent there's been excessive leverage and excessive borrowing in China, and that at some point there are going to be large defaults that will take place, Well, fine, they may step in, but they're going to have to, of course, step into the way, which will divert resources from elsewhere in order to cover over those losses. And so they will potentially be imperiling their growth miracle if they start behaving in a way where firms become too big to fail. And they bail them out as a matter of course. Now, of course, given that the Western world has been doing this ever since 2008 with some regularity, and indeed, we're seeing it in Italy. We're seeing it play out in Italy now with the banks, right? They're arranging yet another shotgun marriage, it appears,
Yep.
amongst Italian banks. I mean, it's not as if it's not as if this isn't already infecting the West. But we wouldn't be at all surprised if China behaves in a similar way.
Right. Now, just as we're a quarter of an hour in, it's now 10:15 in the morning. I thought we'd run through a few questions that we have received from our readers. If you are watching this live, or if you are watching a recording of it, if you're watching it live, feel free to leave a comment in the chat. Or if you are watching a recording of this, please leave one in the comments below, and we shall be looking at those in future episodes and coming back to them. Now, one that I received that was emailed through to me comes from Bob. Bob says, Bob asks, with the Federal Reserve now giving unlimited funding into the reverse repo market, does this mean that they are now prepared to provide funding for the world's banking position? If so, can the dollar possibly not be seriously devalued with this massive issuing of dollars? In addition, I have read that the Federal Reserve needs to refinance $8.5 trillion before 2022, being short-term debt rolling over. With their continued stimulus payments and budget deficits, the amount of dollars to be issued has been described as eye-watering. Now, I believe when it comes to the refinancing of $8.5 trillion, I would imagine that is not the Federal Reserve, but the US Treasury. Feel free to correct me on that, John. But that is Bob asking about reverse repo, the esoteric corner of the market that became much more front and center after the Federal Reserve started injecting enormous amounts of credit into it. And that would have begun around end of 2019, if memory serves. John, what's your take on what the Fed's doing with reverse repo, and what does it mean for the dollar?
Well, look, I mean, the Fed has created an enormous amount of liquidity throughout this crisis. And of course, the government has been spending a lot in terms of stimulus. But notwithstanding that spending and all that liquidity creation, you haven't had a sustained pickup in money velocity. And so that liquidity is not really flowing through into real economic activity in a way that automatically would show up as being dollar negative. Now, longer term, it is, right? Longer term, the dollar, in my opinion, will remain on a downward trajectory, but that has a lot more with the U.S. balance of to do with the U.S. balance of payments rather than this amount of liquidity that's been generated, which is very narrow money, as it were, and which does not easily creep out into real economic activity generally through bank lending and so on and so forth. In fact, bank lending in the US is flatlining, right? It's really not picking up at all. So you're not getting much traction here. Sure, you're getting stimulus checks that are being spent, but you're not really getting firms borrowing and investing in a way that would result in velocity picking up meaningfully. But the dollar, because of the external accounts, is always under pressure. The U.S. needs roughly, and this is a round number, of course, roughly 2 billion of foreign inflows every day just to cover its current account gap. That's like kind of the daily current account gap. That is the amount that the U.S. is effectively borrowing from the rest of the world on a daily basis, roughly $2 billion. If it can't get that at prevailing interest rates or in the form of foreign direct investment, then the only way for markets to clear is for the dollar to decline. So the dollar's under this natural pressure to decline going forward, unless, of course, at some point, the U.S. simply becomes a fundamentally more competitive economy and they no longer import far more than they export. And it's possible that could happen at some point in the future, but I see no sign of it. Right. If anything, the U.S. current account gap as a percentage of GDP is structurally higher today than it was in previous economic cycles. So this in of itself, this huge repo takedown, in of itself, explosion of what we're over $1 trillion now in the repos, that in of itself is not dollar negative. However, it is indirectly symptomatic of a situation that I believe is. That is, the U.S. is papering over what is an increasingly not competitive economy with fiscal and monetary stimulus. And that is a recipe for dollar weakness down the road.
Right. So in answer to Bob's question, when he's looking at reverse repo specifically, while an enormous amount of credit is being forced down the reverse repo market's throat in order to keep it quiet, as it were, that money is not reaching the real economy, so it's not being spent into real goods and causing an inflation in prices, and that's why we're not seeing an immediate devaluation of the dollar in that manner. However, this is symptomatic of a much greater problem, which is very bad for the dollar. Yeah, John, just in terms of when we're talking about the $8.5 trillion before 2022 in short-term debt, I remember when, it feels ages ago when Trump and Mnuchin were in power, but Mnuchin took this very interesting decision to make to change the credit structure, the maturity profile of the U.S. government's debt from being long-term to short-term, which I thought was a very interesting move, because at the time, there was still enormous appetite for long-term debt, or there seemed to be when you look to long-term debt of other nations and of companies. I mean, it wasn't that long ago that the French electricity provider EDF was issuing century bonds. So people were lending money to a French energy provider for 100 years, being very content with the small yield that they were getting out of it because it was higher than everywhere else. And Mnuchin made this decision that he was going to roll a huge amount of the US's debt into short-term debt. So they paid off a load of their long-term debt by raising money in the short term, and were just they're very content to keep rolling that over, and that's continued until now. And I believe that's what Bob is referring to when he's talking about $8.5 trillion in short-term debt needing some kind of rollover. What is your take on that? Because it feels like when you've got debt repayment coming up in the more near term, it makes the subject of debt much more much more sort of real. I mean, it's much more present. So you see it more in the news, and obviously the Treasury needs to make a lot more. Needs to do a lot more just to keep things rolling over. What do you think? What do you make of that? Because I still don't really understand why Mnuchin did it. Because they saved a few bucks because it was a lower interest rate. But
yeah, I mean, look, I think there are two reasons why he did it. One of which is very straightforward, which is simply that if short rates are effectively zero, and long rates are whatever they were at the time, 1.5% or something like that, then you're simply saving money. Other factors equal, right? There's a second reason though, which is that by taking all of those long maturity bonds out of the market, of course, you have all of your investors, institutional investors, who are kind of forced to buy long-term, low-risk debt. And if there's less government debt out there, they're going to have to buy something else, and that's likely to be mortgages, for example. So that brings down mortgage rates, which stimulates household spending, other factors equal. So not only do you save interest expense, but you also stimulate consumption, growth, taxes. And so you could argue that from Mnuchin's perspective, these are two kind of compelling reasons to do it. But they're both very short-termist, right? and so what you're doing, right? I mean, it may seem nice. Oh, short rates are zero. Let's roll it all into the short end. But the problem is, if the Federal Reserve starts raising interest rates, then your interest expense is going to go up essentially overnight, right? It's going to go up very, very quickly. Whereas if you'd locked in those low rates, 1.5%, whatever, for 10 years or longer, then you don't have to worry about that. The Fed can go about tightening policy if needed to get inflation under control, and the Treasury won't find they're suddenly facing a much higher debt service bill. And indeed, I don't have the numbers to hand, but if the Fed were to get rates back to something approximating what we used to call normal, okay, 3%, 4%, 5%, and you take the US's current interest expense and adjust it for that, I mean, it's unbelievable what an impact that will have on government finances. It's going to force cuts in the defense budget. It's going to force cuts in entitlements. There's just no way the US can service its debt at those sorts of interest rates. And obviously, politically, that would be a very, very difficult situation for the government. So Mnuchin, in a way, he's left the current and future administrations with the legacy of what was a very, very short-termist, expedient decision on both counts, that is interest expense as well as stimulating growth. So it's a one-off, right? It's a one-off. You can only do it once. And so unlike the UK, for example, I mean, the UK has a has a similar budget problem to the US, and that is in terms of the potential impact on debt service from higher rates. And yet, the maturity of the UK's debt, the maturity profile is much longer than the US.
Yeah.
In fact, I think it's twice as long, roughly. And so the UK is actually in a better position in the event the Bank of England finally decides they need to start tightening policy in order to keep inflation from rising too far beyond their target.
So a good thing for the UK in some respects, we do have something of an advantage. If memory serves, I think the what's the maturity on the ultra long US government bond, John? Because I think in the UK the bonds that we issue here you can get a much longer dated gilt. I think you get and we used to do the perpetual ones, which were issued during the Napoleonic Wars and that, but they were retired.
Yeah.
Consoles, but they were retired, I think, in 2014. But you can still get 50-year UK government debt, whereas for the States, is it 30 years is the cutoff?
There's been discussion in the States going longer, but instead the discussion then pivoted towards plugging the gap between 10s and 30s with 20-year debt.
Yeah.
But I mean, whenever it's possible that the U.S. will decide at some point, given we are in such a low rate environment, why not lock things in for 50 years or longer?
Yeah.
I mean, the United States, does have a welfare state, whether it chooses to admit it or not. A welfare state has very, very long dated liabilities, especially when you consider that a lot of that welfare state has to do with healthcare and pensions for elderly people, and the same is true in most of Europe, of course. And so you could say it's entirely logical in terms of risk management to be trying to match your assets and your liabilities, and in this case, matching your debt liabilities with your welfare state liabilities. I mean, to me that would be the sensible thing to do. And perhaps the political winds will blow in that direction, but they haven't yet in the U.S.
Right. It does seem, there have been a couple of times where the Treasury Secretary, I can't remember if it was Mnuchin that did it, or he was interested in doing it, where they went to the bond market and were thinking, asking their major participants in the bond market. They're called primary dealers over in the US. Over here, they're called gilt-edged market makers or GEMs. But ultimately, the banks which deal very directly in the US bond market, asking if you'd be interested. Would you be interested? Could I interest you in some ultra-long US government-dated debt? And when they did that, I think that I remember seeing two articles on this, and there was quite a gap between them. I think Mnuchin tried it, and I believe Secretary Yellen currently has raised it, though I could be incorrect. It may just have been during the Trump administration, where Mnuchin wanted to know whether or not the primary dealers would be interested in some very long-dated U.S. government debt, and the answer was no, which I thought was quite interesting. So it was like, maybe this is the market saying, we have very little faith in the US's credit position going out more than 30 years, or maybe there's something else going on with that. This does actually lead us quite well into another chart I think we should share. This one would be it comes to the topic of high yield not yielding very much, which has been a theme which we've seen quite a few times over the past decade, really. But this theme we are now revisiting in ever greater fashion, as it were. So if you're looking at this chart today, this is the triple C. So this is junk debt. Well, it's called junk debt in bear markets. It's called high yield debt in bull markets. And this is just how much yield, how much interest that you can get over some very bad credit. Ultimately, this is or not bad credit. I mean, these are companies which are not viewed as creditworthy as some of the more primary, the better grade stuff. And recently, it was less than 6%. So less than 6% yield you could get from lending money to a very low credit rated business in America. So these are the junk bonds, and they're not yielding very much. People go to these things in order to get a bit more yield than you can get in government bonds, and for whatever reason, there's so much demand for it that the yield has gone down to ever lower lows. So recently, it has come off that level. We are looking more like 7% now, but only a couple of weeks ago, you were looking at 6% or less, which is quite remarkable considering that, not long ago, you would be seeing much, much higher interest rates being demanded of these companies, which are not trusted very much with capital. And, the lower these interest rates go, it does point to interest rates simply being really, really low everywhere. Huge demand for yield, however you can get it. And the fact that junk debt, the triple C's, as we're looking at here, it just shows you that people want yield, and they really don't care how the lack of creditworthiness of those issuing it. John, what do you make of all of that? I mean, it does seem every time we see junk debt go to ever lower lows when it comes to yield, so ever higher highs when it comes to price. Every time it happens, it seems it seems incredible and like it couldn't possibly go lower. But at this rate, I mean, we're going to be seeing junk debt go to lower than 6%. I mean, where does it end?
Maybe. I mean, look, people want income, right? It's only natural, especially if you're retired, right? What are you going to live off? You can't live off wages. You've got to live off your income. And when inflation rises, you would like your income to at least cover inflation. And now we've got inflation in the US at 5% year over year, round numbers. And so the fact that people are looking for 6%, well, they're still only getting 1%. Which is not exactly great in a historical comparison, but what choice do they have, right? I mean, so basically this reach for yield is a very common thing, and you see it whenever interest rates are artificially low and central banks are stimulating to try and get their economies going. It's normal. Obviously, you can reach for yield in multiple ways. You can extend duration or maturity, as it were, and move into 10, 30 or longer dated bonds. You can move into non-government bonds, such as mortgages that offer a little enhancement versus that. You can move into corporate bonds, starting with the safer stuff, single A or higher, say. But then, hey, you get into a situation where all of the above are failing to even cover inflation. And what do? You just keep going down the ratings into your triple Bs, double Bs, single Bs, and then eventually triple Cs and whatnot. The debt of firms that are literally at default's door. But you just hope that you can roll the dice a few more times before something bad happens. And to be fair, I mean, you could look at the history of the junk bond market. The fact is that junk bonds, or high yield, whatever you want to call it, has equity-like characteristics. However, it is senior to equity. And it occupies kind of a sweet spot for investors who believe that the system is just too big to fail, that the Fed will always have the markets back. And whereas equities may take a huge hit, if you take a look at how high yield has done in the past, when equities have taken a huge hit, of course, high yield takes a hit too. But in risk-adjusted terms, high yield's actually held up all right in the last few cycles that we've seen. So, I mean, not that I would advocate this necessarily, but the Fed has de facto been bailing out effectively the high yield market on multiple occasions. Why not invest in it then, right? If the Fed has your back, I think that's part of the mentality here too.
Yeah, they do say, well, they don't fight the Fed has been the name of the game. So, and of course, Jerome Powell is a private equity guy, so he does have background when you're looking at bond spreads, and he gets worried when bond spreads, so the yield that you can make on junk versus the yield that you can make on government bonds, when that starts to move out of the way, that's when he gets really worried, supposedly. So yeah, the Fed's got your back. So do you think we're a long way away from knocking on default's door then, John?
Well, I mean, in a systemically dangerous way, there's just no way the Fed is going to allow a general run on high yield debt. They just won't do it. Now, again, don't get me wrong, high yield may take a big hit if we get into a risk-averse environment, if the economy comes off hard, if the Fed feels it has to raise interest rates and has no choice to try and keep inflation from rising any further. But yeah, I mean, if it gets to the point where it's threatening the system, absolutely. I mean, look, Powell is an insider's insider. Okay. I mean, I used to work on the same floor with him when I was at Bankers Trust Company in New York. There was a merger done with I forget, was it Dillon Reed? Yeah, I think it was Dillon Reed and Company.
Okay.
And Powell came in from there and basically took over corporate finance because he was already way back then a very, very senior, experienced guy, private equity, leveraged buyouts, management buyouts, all these sorts of things, right? He knows everyone. Okay. He has a hotline to everyone. He has the best possible information that you can get. basically, at right there on his desk. Pick up the phone. Of course, everyone takes the guy's calls. Now you have to hope, of course, he's running the Federal Reserve in a way which takes the broader interests of the American public at heart. But he, I believe, also wants to protect his mates, right? And he will do what he needs to ensure that things do not get disorderly.
Yeah, that's very interesting, John. That sort of that insight with viewing him as the consummate insider. When when you take the previous Fed chairs who weren't getting their hands dirty in capital markets nearly so much, likes of Janet Yellen or Ben Bernanke. It is interesting to see now that you've got a guy like Jerome Powell at the wheel. What's been going on?
It is very different, and you're right to point this out, and I should have mentioned it. Yellen is a career academic, Bernanke, career academic. Greenspan did have his own private consulting firm, but one with a very academic approach and focus in its methods and the types of consulting work that he did when he ran Townsend Greenspan. And so you've had this long period of academics running the Federal Reserve. Now, that doesn't mean they didn't have their own connections. It doesn't mean that they weren't, also very savvy in certain aspects. But Powell is the first Fed chairman we've had in a long time who's a Wall Street insider's insider. He is a different animal in that regard, and he's going to be that much more in touch with the guys running the show and ladies running the show on Wall Street than any of the previous Fed chairpersons were.
Yeah, and relating this to the high yield sort of sector, as we just took a look at that chart and the yield that you can get on it, it's a great time to be in high yield. And if memory serves, did the Fed not set up a facility for buying shares in junk bond, in debt ETFs during 2020? I think there was one case where shares in HYG, which is the high yield ETF, were actually bought effectively via BlackRock. But
yes. So BlackRock has kind of become the capital markets arm of the Fed in a way.
Yep.
They have this mandate, which is currently narrow, but you know what? It might get a lot broader. But they have this mandate, which is to try and run in supposedly passive, impartial ways the ability for the Fed to effectively extend credit to corporations, including corporations that may be struggling to get financing on attractive terms.
Yep.
Now, I personally consider that to be a gross violation of the Federal Reserve Act. But by getting BlackRock to sort of do it on their behalf, there's sort of this runaround that I guess some lawyer is able to justify and explain. And whatever. I mean, this is how this is politics, right? The Fed has become a highly politicized institution, so perhaps we shouldn't be surprised.
Yeah, it is interesting to see BlackRock become sort of the mercenary sort of state utility fixer for the Federal Reserve. But it's hard to imagine BlackRock in that way, as it's just so enormous now. BlackRock is just a huge business that's become. It was already a big firm 10 years ago, but the way it's just become this enormous behemoth within capital markets, and now this state, almost like a state actor, is quite extraordinary. There is another question I think we should deal with. This one comes from Christopher. Thank you for it, Christopher. It was sent in to me a little while ago after our last show. And Christopher says, I found your interviews with John Butler most interesting and valuable. Well, thank you very much, Chris. Would you please discuss the question of demographics? Pension funds, both corporate and personal, becoming net sellers in the face of declining demand. On the face of it, a portfolio of global value equities, TIPS, Treasury inflation-protected securities, index-linked gilts, and even gold bullion and miners is vulnerable, though gold perhaps less so. In the hierarchy of threats, where does one stand? What avoiding action and when? With appreciation, Christopher. This is a very interesting question, and it's one it's very hard for me to bend my head around it. So Christopher is asking about when the boomers retire, what does this do to capital markets? Because one would expect that if boomers are selling the assets in their pensions, in some ways this actually happens automatically with the what's called lifestyling plans here in the UK. There's another word for it. I think they're target date funds in the US, where pension funds will automatically sell equities as you get older. And I believe in the US, it's by law you have to start selling things in your 401k. Thankfully, we don't have that over here. Once you reach a certain age, you have to start selling the assets that you've accrued in your 401k. Now, so what happens when all the baby boomers retire? Because we are getting to, we're getting pretty close to like when the boomers start retiring en masse at this point, unless, of course, they haven't saved enough money yet, so they have to keep working. So if they've been saving all this money into pensions, what happens when they all start retiring and start selling those assets? What does this do to bonds, equities, everything?
Well, there's the saying, right? Demographics is destiny, and that is certainly true, right? In a general sense, and in fact, it's almost easier to generalize here because there are so many specific rules regarding, what gets favorable pension and tax treatment at what age, under what conditions, and it varies by country. Sometimes certain things are grandfathered, sometimes they're not, and they're migrated to a new system. Also, you have occasionally a raising of a retirement age before pensions even kick in, et cetera, et cetera. So it's kind of hard to get too specific because for all I know, they're going to change the rules again tomorrow. But let's look at the general picture. You have this big boomer generation, which is followed by a bust generation in terms of population. And that sits then between the boomers and the millennials, which is once again a very large generation, which has entered the workforce, of course, but they haven't yet begun to be net savers.
Yep.
Okay, they haven't got that far yet. And in fact, they're struggling to get that far for a variety of reasons that we don't need to go into. But in any event, that's where we currently are. So basically, you're going to have more and more retired people and fewer working people. Now, what that means, of course, is that you're going to have this mismatch between the nominal asset values being held by the boomers and the amount of economic value added being produced by the real workers in the real economy. And how is that market going to clear? Well, on the one hand, it clears because the boomers are selling assets, and that will actually drive other factors equal, that will drive down the valuations on those assets. Okay. And on the other hand, you're going to have these real workers in the real economy producing the actual goods and services that those boomers need and want. Well, guess what? They're going to have to pay more. They're going to have to pay more. And so you're going to see per capita incomes rise, other factors equal, for those workers. And so you're going to have this imbalance that has kind of built up, as it were, as a result of demographics. You're going to have it, it's going to begin to rebalance. And in fact, you're already seeing this in Japan. And this is an interesting one. Now, it's still early days yet, but Japan, of course, is way ahead in this demographic wave vis-a-vis the West. And wage growth in Japan finally began to pick up pretty substantially a few years ago, following years and years and years of real wage deflation or stagnation kind of in Japan. Real wages have begun to pick up again. Young, productive Japanese people are actually seeing their incomes rising at a rate now, which hasn't been seen for a long time. And I think you're going to start seeing a similar thing in the West. Productive young people who are relatively few in number compared to retiring boomers are going to have more wage pricing power. They are going to be able to demand better compensation. And you're going to see this imbalance begin to correct. That is, asset valuations will begin to decline relative to the real wages of workers in the economy.
Right. What does that do, though, John? Because you're talking about wage increases, wage inflation, and how that may, obviously that then trickles through. Wage inflation will trickle through to some degree into more broader inflation. Bonds are, of course, owned by, you're pretty much forced to own bonds to some degree when it comes to, pensions where you don't actually have control over what's being allocated, what's being owned. Inflation would be very bad for bonds, or unless
absolutely. Absolutely. But this is the point I'm getting at. Boomers are not as wealthy as they think they are. They're not as wealthy as they think they are because their bonds are being eroded by inflation. which I think is going to be higher on average than people currently expect for the next, whatever it is, 5, 10 years. Okay. And also equity valuations in real terms are unsustainably high. So boomers feel really wealthy, wealthier than I believe they're going to end up actually being in retirement. Whereas your young, struggling millennial workers are actually going to find that they begin to do somewhat better than they're doing now. And they might be mildly pleasantly surprised. Now, it depends on, of course, what happens to the tax code, how much of those earnings they'll be able to keep. But this is a huge imbalance that has built up. Assets are overvalued, wages are too low. The two are going to have to correct to restore balance in the economy. That will occur naturally, no matter what happens to the rules, as it were. It will happen naturally. The government may, for political reasons, try to interrupt that by throwing more stimulus at markets to prop up valuations, or by trying to cap wages, or by trying to tax those wages at a higher rate through bracket creep or whatever it is. But in theory, that this demographics is destiny in this case should naturally play out with financial valuations declining relative to real wages.
Okay. On that then, John, if we sort of explore that further, if we do get the millennials earning more and, sort of finding some of the wealth that the baby boomers managed to accrue, so they're starting to earn some serious capital, are they going to be, is their buying power going to be high enough that the property market, for example, manages to maintain its valuations? Or the equity market, so the amount of pension flows going into equities that keeps the market quite buoyant. Do you think millennial pension flows are going to get to the size where they will be able to keep the stock market buoyant despite baby boomers sucking capital out of it?
Well, again, in nominal terms, everything might still go up in price, right? I mean, if the Federal Reserve and the banking system generally are going to continue expanding the money and credit supply sufficiently, nominal prices will never decline ever. Okay, but when you think in real terms, okay,
Right.
you've got let's focus on property for a moment. Obviously, you have a lot of houses, you have a lot of residences, you have of all kinds, and right now the multiples vis-a-vis average incomes on those properties are historically very high. That's certainly true in the UK. It's true in the US. It's true in Canada. It's true lots of places.
Yep.
That is one of the imbalances that we'll need to correct. So those boomer households who might have more than one house, they will, as part of their dissaving, some of them will downsize. And there will be some natural selling pressure in the housing market. And the millennials will find, other factors equal, this will take a few years, but the combination of housing valuations declining a bit and their real wages rising a bit, they might find, to their pleasant surprise in 10 years time, whatever it is, that they can actually afford a decent home. I certainly hope it plays out that way. And I think it will play out that way, subject to governments not going through, who knows what measures to try and prop up housing artificially in order to please the boomer lobby and still keep the millennials in a disadvantaged situation, which I think is grossly unfair.
Well, yeah, that sounds like good news for my generation. Not so good news for my parents' generation, John. Thank you for that. It will be very interesting.
Well, but hold on. But your parents, come on. I mean, they've had this tailwind for a long,
yeah.
long time. Okay, guess who really gets squeezed by this is the people in the middle. It's generations X and Y that get squeezed in the middle. They didn't get much benefit from the tailwinds, and they're not going to get as much benefit from the upward pressure on real wages that the millennials are going to get. So they're the ones who really lose out in this.
Oh, big time. The middlemen of history.
Yes. Yes.
I have a lot of sympathy for Gen X, and I do believe that the baby boomers have a lot to answer for, considering where we have gotten to when it comes to capital market structure, property prices, things like that. It will be interesting to see how it happens. The problem with these generational shifts is, of course, it takes time. So everyone wants,
yes.
Good luck.
It's almost impossible to play this as an investment theme because the time horizon is too long, and the best you can do is just to structure your portfolio in a conservative and sensible way, regardless. And if you perhaps want to try and incorporate a little of this into your planning, by all means do so. But the idea that you can trade it this way and that, You can't.
Mm. Well, we do have our fellow editor at Southbank Investment Research. We do have a service here called Reflex Trader, where one of our editors finds a way of just looking at the pension flows that go into 401ks over in the States. As Americans get paid fortnightly rather than monthly, you can actually see when those pension funds are buying equities. And so doing a lot of backtesting on when the US stock market does well, he did discover that during those days when the 401k funds are being invested, so on paydays effectively, you do find that there are, on those days, the Dow Jones, for example, does seem to do a fair bit better. It's like it's a little luckier on those days. But of course, that is very, very short-term sort of trading view, and of course it doesn't work every time because pension flows are not the be all and end all of stock markets, though of course they are becoming a very, very important part of them. John, we have been carrying on for a little while here. Are there any closing remarks you'd like to make here? We have made it to episode 5. We haven't had too many questions in the chat. We do have a note asking us to start these live streams closer to 10 o'clock in the morning, which is we shall be taking that on board. Have received some great emails. I hope everybody who has emailed in will be able to watch the recording of this. And of course, if you are watching a recording of this, feel free to leave any comments regarding feedback or topics you'd like us to cover. But John, any closing remarks for today's episode?
Well, I guess I would just say that I do think that, and I've been saying this for weeks, I do think there are accumulating warning signs that we are going to see a material correction in equities and other risky asset markets sometime soon. The evidence keeps piling up, in my opinion, and I just think it pays investors to be rather cautious now. And but again, the definition of caution has changed in a world where bonds don't yield anything. And cash itself, right, doesn't yield anything. As I frequently tell my consulting clients, in a world of zero interest rates, sitting on cash and waiting for a stock market correction is not a viable investment strategy. You do need to do something, and that something, in my opinion, given where we currently are, is to hold an unusually large portion of gold and precious metals in your portfolio, because they protect you from the inflation, which is clearly coming through now, but they don't expose you to the risk of the stock market or the high yield market, for that matter. So I think that is a very just sensible thing to rehash here in that context.
We are certainly very big friends of gold here at Southbank Investment Research. Though, of course, episodes of Southbank Live, we cannot give any personal financial advice. These are for educational, informative, and hopefully entertainment purposes only. But I hope you have enjoyed this episode. We shall be back again next week. As I say, if you have any feedback, any future things you'd like us to cover, do feel free to leave them in the comments below this video. And of course, do subscribe, because we do plan on doing more of these in the future. But that's all from us for the moment. John, thank you so much for joining me.
Thank you, Boaz.